Everyone, welcome to today's session. Let's jump right in here and talk current market conditions. We're continuing to see some weakness here in the market, and we'll start here with directional alerts, talk about our long-term perspective, and we are towards the upper end of this trend, this 20-year trend, and this upper line right here is the, let me get my drawing tool here, 1 second here. The momentum, the 1-year momentum trend sitting up here at the upper range at 25.35 and certainly elevated. We've been talking about how elevated that has been for quite some time, and we're starting to get some divergence on that as well, where we don't have a new price high on price, but we are getting some weakening where this is rolled over, it's moved up and started to trend back down again with some of this recent retracement that we've seen. We're also seeing some weakness in momentum. We'll just come to this chart. We're in this hold range now. Momentum also, breadth stuck in this middle hold trending range, and sentiment also. Sentiment had weakened a little bit yesterday, a little bit more strength there today. Buy-sell ratio is also showing some weakness at less than 1.51. So bears in control right here, and looking at an area of we've broken through some support on S&P 500 and looking at retesting that area right here, that 548 area on S&P 500, and it's trying. We'll see if we can get a rally and move back up again, but that's a weakening pattern here now that we've broken through that significantly on that real big downturn the other day, and now we're getting relatively tight price activity inside of that range. So we've got the market as a whole now, S&P 500, in that same pattern, that same formation that we start to see when a stock itself is starting to lose trend, it's starting to lose momentum, and this is the location where typically it's going to find that support and bounce and start to move higher, or it's going to continue to slide to that downside. So some of the areas that we want to be watching for on S&P 500 is this range right here, this 548 area. That's a pretty significant range, and where price has been at before. This breakout pattern, it was retested, it broke down through that, popped back up a little bit above that last month when we had that sell-off, and now just starting to weaken again. So the momentum right here at this level just couldn't quite hold, at least without some kind of a retracement. Doesn't necessarily mean things are going to completely fall off the table, but it means that we're now working on more of a counter trend corrective zone that is going to increase the probability of more sliding, of more downside, particularly coming into August or into September, October, traditionally are bearish months. November, December, traditionally are bullish months. So some of that seasonality starting to come into play here as well. The price activity is the most important thing, not necessarily the time of year that it's happening, or that it should happen, or that it shouldn't happen. It's happening, and that's really all we need to be aware of, is that we do have price action that is starting to weaken. We've talked about some of the underlying thesis of why this could be happening, and the main thesis that's still underpinning the market as a whole is interest rates and inflation, and Federal Reserve, whether they're going to cut, whether they need to cut because of recession or a weakening economy, or because they have inflation under control. And so that's really what the market is looking at, is all these data points now regarding economic growth, regarding unemployment, regarding the labor situation as well. Are companies laying off employees, or are they hiring? And so the market hasn't liked in this last week some of those economic data revolving around employment, and so that really no news within the last couple of days. So maybe a little counter trend move happening right here at these levels. Now, when we talk about these areas, we talk about what does that mean in terms of what should we be doing right here? Well, the probability of a retracement is very high, because the probability of this staying high is quite low. Okay, it just doesn't stay. Markets don't stay this elevated in their trend for very long without some kind of a counter trend. It doesn't necessarily have to be a real deep one. This one was a little more situational with COVID. Back here is a little bit more normal looking counter trend type of move, but we've had a lot of hype in this run up. We've had a lot of focus around AI. We've had a lot of focus around inflation and the Fed cutting and what that means. And so the market is anticipating some things that may or may not start to unfold now. And that's really one of the things to be watching for. We do have bonds that have been working nicely, continuing to move higher. And again, that is in anticipation of more Fed cutting or lower interest rates to come. So the bond market still believes that is in place. The long-term bond TLT, the short-term bond SHY also up again today. Now these on a percentage basis, these are nothing impressive, but they look impressive. If we were looking at a stock on this, that might be a 10, 15, 20% move, but with treasuries, it's not quite as much. And so we're not as concerned about the price activity and the movement and the trade on SHY as we are paying attention to what's happening with the bond market and looking to see, does the bond market still continue to believe that rates need to be cut? And that is the case right here. So even more ammunition for the Fed over the next, coming up here soon. I believe in the next week or two, we're going to be seeing whether or not they will be cutting. The issue now may be whether it's going to be a quarter point or a half point. Well, or all of that is really kind of irrelevant. The fact is, are they going to cut? And then secondarily, how much are they going to cut? And those are all going to have market moving activity to them. So point being, we still need to be very, very light, in my opinion, towards the bullish side. The portfolio currently, we have pretty small positions now in terms of 4, 5, 6 positions, and got stopped out of quite a few things, just relatively low right here. Now, as things start to weaken, these are areas where we have buy-sell ratio that is bearish. Red is above green right here. That means that there's more stocks in downtrends than in uptrends, and really that is the market, right? The market is just all of the stocks. In this case, we're looking at a certain group of stocks in our database. You can also look at these indexes. That's all they are as well. An S&P 500 is just simply an index of 500 stocks, and this is how the price of those 500 stocks are moving together. So in essence, that's what you're starting to see here, is weakening in that group of 500 stocks. You're getting weakening in this group of 1,000 stocks, the Russell 1000, weakening in this group of 3,000 stocks, weakening in this group of 30 stocks. Dow Jones Industrial Average is 30 stocks. NASDAQ 100, the triple Qs is 100 stocks. So each of these indices are nothing more than a group of stocks that are doing something in tandem, and essentially, the averages of those stocks together. It's not exactly like that because a lot of the indices are weighted averages, meaning there are certain stocks that get more weight in this calculation, typically market cap weighted. So your Apples, your Microsofts, your Amazons, your Googles, your Metas get more weighting in these. And so we're continuing to see weakness here as well. Let's jump out to the 1-year time frame on NASDAQ and see that 1 year. Let's actually go out to the 2-year, because that 2-year uptrend, we retraced, we pulled back into this range right here, and we saw some buying. So now we're pulling back to another pretty significant support zone on NASDAQ. We'll see if we do get some support. We could get a rally moving back up into this area. We could see some support. We could see continued sliding right here, but we're at one of those kind of decision points or indecision points, depending on the market and what's happening. If we look at the S&P 500 over that longer time frame here as well, not quite as concerning, but this is the way it starts. Okay, and this is when we start to see trends start to slow down a little bit, or trends start to falter, particularly towards the upper end. And these are all-time highs in the stock market in the S&P 500, and so watching how these start to retrace. Now again, I go back to, what does that mean? Well, what it means is when we're trying to fight the market, we have scenarios like today in the last couple of days, and that is we're getting stopped out of trades. Okay, so if we don't necessarily want to fight this downturn, we can do one of two things. Number one, we cannot have any new trades while the buy-sell ratio is bearish. Okay, so buy-sell ratio here 0.51, we're bearish. the bulk of those stocks moving lower, that typically means that the weight towards the market to the downside is a little bit higher right here. We also have price levels, S&P 500. We go into that 6-month time frame, which is really kind of our key analysis time frame. We're also running into some weakness. So do we want to fight that trend and say, yep, sure enough, we're going to rally higher because of XYZ, or do we want to be a little bit cautious right here? Well, based on this context, we know that we need to be cautious. We're at the upper end of this range. We're at extreme levels on momentum, which means the probability of continuing to get aggressive moves higher is pretty small. Individual stocks can do well. That's why we are still picking some stocks. But even then, in bearish markets, a lot of trading algorithms that are trading indexes as a whole are just selling the entire thing. So you get the baby getting thrown out with the bathwater. When you get a market that's in retracement, you'll still get good stocks, or stocks that normally would be trending or looking good that just don't, because they're tied to the market as a whole, and just selling creates more selling across the board. Okay, so these are certainly areas right here to be very cautious in terms of the allocation assigned to equities. Again, in my opinion, everybody's got their own perspective of how to manage these moves, how to manage individual portfolios, and this is just one perspective to be able to consider in terms of what to be doing and why. Now, that doesn't necessarily mean that's more of a trading mindset. In terms of a portfolio mindset, that maybe like your 401k or something, where you've got a little bit longer term assets and you're just moving from stocks to cash or something like that, then similar type of portfolio allocation to say, the bulk of it shouldn't be in equities, right, at these levels, just because we're at these, for all of the reasons that I just discussed. We still have this bond yield curve. That's why we keep talking about interest rates. This bond yield curve has to come down, and it hasn't yet to any real degree. And so typically when this inverts and we get shorter term, the short end of that yield curve higher than the long end of the yield curve, then it almost always turns into a recession. Stocks are not pricing that in yet. When it happens, if it happens relatively quickly. But we could be starting that phase. We're definitely seeing some weakness in this, at least in this most recent trend. If we rally and head back up again, nothing changes, but the market just could be moving for one more push higher, and then waiting for additional economic data to decide, oh, is the Fed going to do this? And then we run into September, where the Fed actually does start to make some decisions, and then we'll actually know. And we'll actually, instead of anticipating or speculating, we'll get some real data. And then it's all about, well, what's the future? Okay, because the market is already saying Fed needs to, pricing in a 50% basis point cut or a 25% basis point cut, or whatever those scenarios are. The market already thinks the Fed is going to cut, and if they don't, then then things start getting crazy again, because the market is anticipating something that it doesn't know for sure yet. Once that certainty happens, then the market can move ahead of that and say, okay, well, what's next? Now we have these rates. What does that look like? Let's move out 3 or 4 or 5, 6 months and see what's going to be happening there as well. Okay, so these levels are right here are areas that are going to create some frustration in long positions, and there's no reason in most cases to be fighting it unless they're relatively shorter term trades, or smaller allocations, smaller position sizes as well. Let's look at the sectors, because we're getting this. I like to use this perspective on sectors because it just adds to the confirmation of the strength of the market. When we have a market that looks like this, then that essentially looks just like that S&P 500 chart. Okay, if I delete that and if I come back to this index and S&P 500 chart, it looks like this part of the chart. Okay, and that is we're stuck in the middle. The bulk of those sectors are in that hold range. Okay, so if I go like this, you can see the bulk of those are in that hold range. That's just additional confirmation to say, yeah, the bulk of the market is weak right here and weakening, continuing to weaken, because we have some to the downside. On the flip side of that, you can look at the winners and losers and say, all right, are these places that I may want to consider allocating money into? If there are stocks that are going to move higher, which ones should I be focused on? Real estate is moving higher. Number one, because it believes that the market believes that rates will be cut, which means mortgage rates will come down, which means refinances can start happening again, which means home purchases and sales may accelerate again and create some activity in the real estate world. Utilities typically are a recessionary type of asset where, you think of a utility, think of your own utilities, you think of your heating bill and your gas and your electric bill. Those are things that we typically don't change, even if we're struggling financially or things are slowing down. We still got to pay the gas bill and we still got to pay the electric bill. And so those utilities are oftentimes looked at as a little bit more stable. Just remember that all stocks are garbage when it comes to safety. There's no safe stock. Anything can drop for any reason, even a utility safe type stock. But in this case, these are ETFs. So these are really broad based. These are groups of multiple stocks. So the sector as a whole has been continuing to hold up in these levels. And let's take a look at that last one, which was consumer goods. Okay, your Walmarts, and remember the other way to look at this, if you want to know what is comprising some of these sectors, one way to go is just to go out here to news, which takes us out to Yahoo Finance, and then that profile is going to show the holdings. We go over to holdings and say, all right, these consumer staple stocks, that's our Procter & Gamble's, Coca-Cola, Pepsi, Philip Morris, Altria, whatever that is, Colgate, Kimberly-Clark. You got your toilet paper, cigarettes, toothbrushes, Pep, and soda pop. Okay, so when things slow down, we've got to have toilet paper, Pepsi, and toothbrushes and soap. So and a cigarette to calm our nerves. So those are things that we're looking for in terms of that sector, why it's improving and why there's strength there. So if you're looking to allocate some of the portfolio position size, instead of going to an individual stock, you could go into an individual sector using a sector ETF and say, all right, I like that utility sector. I like that consumer goods sector. It's holding up. It's showing some strength. And if I do want to be invested in something at all, then maybe that's an area of the economy that I can add into my portfolio. I'd still use the same function, the same structure, and say, I still want to buy when we're in this upper bullish trend, when we're in momentum and above that area. Okay, so in this case, it's not necessarily a great position for a new addition, for a new buy without some kind of a pullback or retracement, but that would be an area that you could be watching for if you are in cash and waiting for some areas of the economy to jump into without buying individual stocks. Because when markets are, think about the risk factor. The more holdings you have, the more diversified you are. So instead of buying just one stock, Procter and Gamble, I could own all of these stocks together, and it just smooths out the ride a little bit. I'm diversified among all of those stocks, and the balance and the battle is that should I have bought Procter and Gamble because it could outperform this one, or should I bought this one because it outperforms this one? Okay, you kind of get away from that to say, I'm just going to buy them all. I'm going to buy them all through one symbol, one ETF symbol that allows me to own those, and then I can still manage it the same way: uptrend, retracement, counter trend, stop loss under my 236 location. I'd manage it still the same way, and I'd still go in and set up the risk profile the same way. Say I want to buy a stock here, what percentage could I go in? How many shares of the consumer goods sector ETF could I buy with a $100,000 portfolio and still be within my acceptable risk levels? In this case, if I did, that's still pretty high. If I went down to 20 shares, that's 1.37. I can go a little higher than that. So 30 shares is 2%. Let's say if I did buy it today and I wanted to have a deep enough stop loss to allow it for some support, that's 70, let's call it $70. Okay. Well, no, that's not, well, that is right. It's because it's a relatively small moving percentage of, because it's such a large group of stocks, not a big price move right there. Okay, so I could have a pretty wide stop even at 70, and my risk is relatively light of getting stopped out, even if I were to buy today and place a stop loss at 70. Okay, so one of the ways that's one of the ideas as far as I still want to buy something that I think is going to go up, even though the market is moving down. It's a lot harder to do. So we want to keep the bulk of the money in cash, and then any of this money that we're using and buying into, considering ETF sectors, is just one of the ways to reduce risk a little bit. Okay, because for example, we had a trade today that's probably, if not close, getting stopped out. Okay, immediate buy, immediate reversals. There's volatility there, and that's that. When the market starts selling again, if it's a fairly light or thinly traded stock, you can get these just real volatile moves, and that's one of the reasons to be paying attention to this broad market perspective. What's the broad market doing? Well, we even here, market conditions mildly bearish. What does that mean? This means traders and investors should consider trading with a neutral or bearish bias, raising stop levels on winners, selling losers. So lightening up on the overall position, lightening up on risk. That's the real value of utilizing the market trend analysis. Is what should I be doing right here? Should I be sitting on my hands? Should I be adding more? Should I be, what should I be doing based on what the current market is giving me? Okay, we can't force it. We can't force what the market is going to do. We can't say I think it's going to go higher, or I hope it's going to go higher, or whatever the scenario is. It just does what it does. We just have to be watching for where it's doing certain things, okay? And not getting sucked into the idea that this thing is going to continue to move higher, or even after a massive bull market and uptrend, it's going to continue to go higher from here. It certainly can. Okay, we get those scenarios where we get a capitulative type move. It really rockets to the upside. But when we have interest rates in the Fed where they're at, you may have heard the phrase, don't fight the Fed. This would be fighting the Fed right here. But the issue is the Fed is going to raise or lower interest rates, but are they going to have to do it now because of recession? That's what the stock market wants to see. It wants to see the rates lower based on inflation, but it doesn't want to see them go lower because of recession. So those are some economic data numbers to be watching for this week. The market will let us know what it thinks about all of these price points as well. Technology weaker. The Dow had been holding up right here at this 236 support area, at 407 range, continuing to hold up. Those Dow stocks are, again, those are your big stable companies. They're not going anywhere. Their stock price can still be volatile, but in some type of a recession or slowdown, investors may be considering those as a little bit more quality type names. Doesn't necessarily mean that that's the place to be hiding out or moving. Again, it's either, in my opinion, it's either in equities or not. You're either in equities or you're in cash. And equities are also considered, an ETF. A sector ETF would still be considered an equity because it's still a group of equities. It's still a group of stocks. We're seeing gold continuing to move higher. We bumped over here to commodities and gold price. This is a really bullish type pattern. It's just been holding up here, this 228 level. Now we're continuing to just get a little bit higher lows. Still getting a little bit lower highs here, but we'll see if we can get a good confirmation move and break that 234 range. Gold might get a nice run here. To the flip side of that, USO is still just getting pummeled here, 4% down today. We've talked about this now where we had this really big wide gap. If this support was broken through, pretty quick trip back down to 65, and that's about where we're at now. Again, so we may see some support here in oil. It's just insanely oversold here. Not insanely, but within trend, it's at a level that typically is not sustainable. So it's not a sustainable downtrend to completely fall off the table and stay there. But you're going to start to see some demand coming back in, more than likely somewhere around these ranges. And again, for whatever that's worth, oil typically in this case could be a good thing. We want to see this. We want to see oil moving lower. That just means lower expenses for those companies that are using a lot of oil as well. So really just wanted to focus on risk management and some ETFs, some sector ETFs that are on the long side. Not necessarily talked about anything that is moving an inverse ETF. Those are other things that you can focus on as well. And leveraged as well. We've got SPSX, which is a leveraged inverse ETF. Let's take a look at that on the 6-month time frame. And let's move in here, shorten that up just a little bit. Come on. There we go. Let me get rid of that volume as well. So you can see as the S&P 500 is dropping, this is going up. Still nothing. These are typically just hedges to be able to buy something while the market drops real quick and then get out of it and say, okay, thank you very much, short-term trade, versus holding it for any length of time, especially the leveraged version of those. But those are also an instrument that's available to be able to manage holding something on the long side of things without having to short in a downtrend to be able to profit or hedge in a downward market. And just to recap, market conditions sitting towards the upper end of this range, getting some weakness. Pay attention to that S&P chart primarily, where it's sitting at 548. We did get some buying back into that today. If it shows some weakness and starts to roll back over again, this is going to be the range that we're going to be working with and talking about here for the next length of time. Who knows how long, week or so, days, if the market gets a little bit more volatile right here. I'm going to end on that note. I appreciate everybody's time and effort, and we'll see you next time. Thanks a lot. Bye now.